In the spring of 2019, Marcus was 38 years old, living in Atlanta, Georgia, and holding a decision that felt enormous. He had $120,000 saved. 6 years of discipline, of deferred vacations, of saying no to things he wanted to say yes to. $120,000 sitting in a high-yield savings account, waiting. His financial advisor told him to buy a house. His parents told him to buy a house. His colleagues, most of whom already owned homes, told him to buy a house. The cultural script around him was unanimous. Real estate is how you build wealth. It is the responsible decision. It is what adults do. Marcus bought a house, a 3-bedroom in a quiet neighborhood northeast of the city. Purchase price, $255,000. He put the full $120,000 down, nearly half the purchase price. His mortgage rate, 4.1%. Monthly payment, $650. Everyone told him he had made the right call. This briefing is about what happened to the people who didn't. By the end of this briefing, you will understand why one of the most documented wealth-building findings in modern financial research is also one of the least discussed, and why the industry best positioned to explain it has a documented financial incentive not to. Here is the puzzle this research presents. The financial advice Marcus received from his advisor, his parents, his colleagues, was not unusual. It was not fringe. It was the dominant consensus of American personal finance culture for the better part of a century. Real estate is the wealth vehicle. Homeownership is the goal. Renting is money thrown away. The research documents something more uncomfortable. Everyone was wrong. Not about homeownership as a life decision, not about stability or community, or the documented psychological benefits of owning the space you live in. The research is specific. As a pure wealth-building vehicle, residential real estate has underperformed a simple S&P 500 index fund in 12 of the last 15 years, by a margin that, compounded over a decade, produces dramatically different financial outcomes. And the industry best positioned to explain this to Marcus, the financial services industry, generated $170 billion in commissions in 2024 from real estate transactions alone, according to Bureau of Economic Analysis data cited by Federal Reserve economists. To understand why Marcus got the advice he got in 2019, you need to understand how homeownership became the default wealth vehicle in American culture, and how deliberately that status was constructed. After World War II, the federal government made a deliberate policy decision to incentivize homeownership. The GI Bill offered returning veterans low-cost mortgages. Fannie Mae and Freddie Mac were created to standardize and expand the mortgage market. The mortgage interest deduction, still in the tax code today, made homeownership explicitly cheaper than renting for anyone itemizing deductions. The government built the cultural norm into the financial system. By the 1980s and 1990s, the real estate industry had grown into one of the largest lobbying forces in Washington. The National Association of Realtors, NAR, became one of the top political donors in the United States, spending more than $1 billion on lobbying and political contributions over the last 2 decades. The industry's financial interest in maintaining homeownership as the cultural default was, by this point, self-reinforcing. Meanwhile, index funds, invented by John Bogle at Vanguard in 1976, were structurally invisible to the advice ecosystem. A realtor earns a commission when you buy a house. A mortgage broker earns a fee when you take a loan. An index fund, purchased directly, generates zero commission for anyone in the transaction chain. The incentive to recommend it simply did not exist in the same way. The Federal Reserve's Survey of Consumer Finances, the most comprehensive wealth survey conducted in the United States, documents that the median American family holds over 60% of their net worth in their primary residence. One asset, illiquid, undiversified, correlated to a single local market. Against this concentration, the research presents a 15-year performance record that has been documented but rarely discussed in mainstream financial media. 12 years out of 15, not a marginal edge. A documented, consistent pattern across bull markets, bear markets, a global pandemic, and one of the fastest Federal Reserve tightening cycles in modern history. But the performance data alone does not capture the full picture, because the comparison is almost never made honestly. But the performance gap is only part of the story. The research documents that the true cost of home ownership, when maintenance, property tax, transaction costs, and illiquidity are properly accounted for, is systematically underestimated by the people most invested in selling it to you. On a $300,000 home, the hidden annual costs documented by Zillow and Thumbtack, maintenance, insurance, property tax, HOA fees, add $15,979 per year to the true cost of ownership. That is $1,331 per month that a homeowner pays, on top of their mortgage payment that never builds equity and is never included in the standard comparison with index fund returns. The industry incentive angle is documented by the federal government. In 2024, the Bureau of Economic Analysis estimated that real estate commissions and related costs totaled approximately $170 billion, 0.6% of U.S. GDP, according to Federal Reserve economists. That same year, the National Association of Realtors reached a $418 million settlement to resolve antitrust lawsuits brought by home sellers alleging that commission structures were artificially inflated. The SEC's regulatory framework distinguishes between two standards: the fiduciary standard, which requires advisors to act in the client's best interest, and the suitability standard, which only requires that a recommendation be appropriate for the client's situation. Broker-dealers, who represent a significant portion of the financial advice ecosystem, have historically operated under the suitability standard. A recommendation to buy a home, even when a diversified index fund portfolio might produce superior long-term returns, can satisfy the suitability standard without violating any regulation. The research does not allege fraud. It documents a structure. Return to Marcus, Atlanta, 2019. He put $120,000 into a house at a 4.1% mortgage rate, and the house has appreciated. By 2024, the Atlanta median home price had risen to approximately $385,000, an increase of roughly 51% on his purchase price over 5 years. On paper, he did well. Now, consider the alternative. In the spring of 2019, the S&P 500 stood at approximately 2,800. By the end of 2024, it stood at approximately 4,769, a gain of roughly 70% over the same period before dividends are included. With dividends reinvested, the total return was higher still. The $120,000 Marcus used as a down payment, invested in a low-cost S&P 500 index fund in spring 2019, would have grown to approximately $204,000 by end of 2024. before accounting for the $15,979 per year in hidden homeownership costs he paid, and before accounting for the $21,000 in annual maintenance documented by Bankrate. Fidelity Investments, one of the largest asset managers in the world, documented the long-term return comparison in their 2024 investor research. The finding is stated in one sentence. Once you hear it, the advice Marcus received in 2019 looks fundamentally different. The S&P 500 has delivered an average annual return of 10.39%, including dividends between 1992 and 2024, compared to approximately 5.5% for the U.S. housing market over the same period. Marcus is not a cautionary tale. His house appreciated, he built equity, he has stability and a community, and the documented psychological benefits of homeownership that the research also consistently finds. He made a decision that was reasonable by every cultural measure available to him. What the research asks is a narrower question. As a pure wealth-building vehicle, was it the best available option? And the data, across 30 years of documented returns, answers that question consistently. The research does not argue against home ownership. It documents 3 patterns among households that have built measurable wealth that are worth understanding. Finding 1. The Federal Reserve Survey of Consumer Finances documents that households in the top wealth-building quartile consistently hold a diversified asset portfolio, housing alongside liquid investments, index funds, and income-producing assets. The research does not document a pattern of wealth accumulation driven exclusively by a single liquid asset class. Housing in the documented wealth-building pattern is one component, not the primary or only vehicle. Finding 2. Vanguard's 2024 How America Saves Research documents that households which maintain consistent contributions to low-cost index funds over 10 or more years, regardless of market timing, produce significantly better long-term outcomes than households that concentrated wealth in a single asset class. The key documented variable was not investment selection, but consistency and diversification. Vanguard cites the average expense ratio of index funds in their data as 0.06%, compared to the 8 to 10% transaction cost of a typical home sale documented by NAR. Finding 3. The SEC's 2024 investor research documents that households which verified their financial advisor's fiduciary status before receiving advice, specifically confirming whether the advisor was held to the fiduciary standard or the suitability standard, were significantly more likely to receive recommendations that included low-cost index fund exposure. The distinction between the 2 regulatory standards is not widely understood by retail investors, and the SEC has documented this as a material gap in financial literacy that affects the quality of advice received. Marcus still lives in his house in Atlanta. It is appreciated, he has equity. He does not regret the decision. The research does not require him to. It asks only whether, in 2019, with $120,000 and the best available data, the advice he received reflected the full picture. The data has been available for 30 years. In Episode 4, we look at the financial product that 43% of American households use every month, that generates more fee revenue for banks than any other consumer product, and that the research documents is the primary mechanism by which wealth is transferred, quietly, legally, and by design, from households to financial institutions.